Hello everyone. In this video, I will discuss how we value a project or a business. So far, we have learned how to find out the value of a project. So this video will more concentrate on valuing a business. On most working days, the financial managers concentrates on valuing projects, arranging financing, and helping run the firm most effectively. The valuation of the business as a whole is left to investors and financial markets. But on some days, the financial managers has to take a stand on what an entire business is worth of. So in that case, you just treat the company as if it were one big project. So you forecast the company's cash flows. I understand that's the hardest part of the exercise. Discount back to present value. But 3 points to be remembered. First of all, if you discount at weighted average cost of capital, the cash flows have to be projected as you would for a capital investment project. So do not deduct interest, calculate taxes as if the company were all equity financed. Unlike most projects, companies are potentially immortal. Companies are potentially to continue indefinitely. But that doesn't mean that you need to forecast every year's cash flows from now to eternity. Finance managers usually forecast to a medium-term horizon and add a terminal value to the cash flows in the horizon year. The terminal value is the present value at the horizon of all subsequent cash flows. Estimating the terminal value requires careful attention because it often accounts for the majority of the company's value. Discounting at weighted average cost of capital values the assets and operations of the company. If the object is to value company's equity, that is, its common stock, don't forget to subtract the value of company's outstanding debt. So you can see that this is how we find out the value of a firm. So we essentially depend on free cash flow. Free cash flow is discounted using weighted average cost of capital. So this part is the present value of the medium-term cash flows, and this is the present value of the terminal value. So this is a more likely model. So the present value of the free cash flows for the medium term, and this is the present value of horizon value. So just to explain this horizon value a little more is we first estimate the cash flows for a medium term. For example, let's say up to year 10. Then we assume that the cash flow generated in year 10 will remain the same for the subsequent years for an indefinite period. So we find out the present value of this constant stream of cash flows. So that's the present value of horizon value. So this is an example of Rio Corporation. So where we have sales, cost of goods sold. After deducting cost of goods sold, we get EBIT. I mean earning before interest and taxes. The depreciation and amortization, we deduct depreciation. We have profit before taxes. Then we have taxes, we have profit after tax, then we have investment in fixed asset, investment in working capital, then we have free cash flow. Free cash flow is the cash flow generated by operation minus cash investment. So here is the present value of the free cash flows from year 1 to year 6. Then we have the horizon value, and this is the present value of the company. So this is the formula for the free cash flow. You can say profit after tax plus depreciation minus investment in fixed asset and minus investment in working capital. So we get free cash flow, and these are the free cash flows from year 1 to year 6. So we find out the present value of this free cash flows, which is 20.3. So as I said, that this is the present value for a medium-term cash flows. Then we calculate a horizon value. So as I previously mentioned, that look that this is the cash flow generated in year 6. We assume that in year 7, it will be increased by a certain percentage, and then it will grow at a constant rate. Okay, you can see that growth rate is 3%. So for the rest of the life, for up to eternity, it will grow at a constant rate of 3%. So this is the present value formula for a constant growth model, if you remember. So this is the cash flow. This is the required rate of return minus growth rate. So this is the value of horizon value, and the horizon value, that means this is the horizon value at the end of year 6. Okay, so this is the present value. That means the horizon value at 0 time. So this is the present value of the free cash flow for the medium term, and this is the present value of the horizon value. And as we sum them up, we get the present value of the corporation, which is $87.9 million. So that's the discussion on valuing a business. The next video, we will discuss tricks of trade and few examples to end the chapter. Thank you very much.